In this lecture, we will go through Elliot wave theory, which is a very important theory within technical analysis that talks about the behavior of stock price movements. So we will discuss the theory first. We'll look at the wave patterns coming out of this theory. We'll also look at corrective waves, so not only how do waves move in the general trend, but how do they correct as well. After that, we'll talk about Fibonacci numbers, Fibonacci ratios, and Fibonacci retracements, all of which are highly related to Elliot wave theory, and we'll see how it all fits in. Okay, let's get started. Elliot wave theory. Let's start with an introduction about Elliot wave theory, talk about what it is generally. In 1938, a man named Ralph Nelson Elliot invented a theory to describe how stock prices move, and he was specifically looking at stock indices, US stock indices, the Dow Jones, among others. Though his analysis is now used in not just stocks, but commodities, currencies, derivatives generally. So we can think of Elliot wave theory as a general theory of technical analysis that we can apply to any asset, but that was initially developed in the context of stocks. And much of the work on Elliot wave theory comes out of Dow theory. If you remember, we talked about Dow theory a few lectures ago. In fact, it was the first lecture of this module. And Dow theory was really a theory about trends, right? Looking at minor trends, intermediate trends, major trends. And Elliot wave theory uses a lot of that information about trends and aims to improve upon it. So it's a slightly more scientific approach, slightly more technical approach, but it really talks about the same thing. How does the trends move in stock prices going up and going down? Differences in Elliot wave theory, we talk about waves. So we talk about prices moving in waves. Okay? So a wave is like one movement upward would be a wave. The next movement downward would be another wave. So we talk about the pattern of waves that we are likely to see whenever we analyze stock prices. And it works in much the same way Dow theory talks about prices moving in trends. Now, Elliot wave theory draws heavily from Fibonacci analysis. So in the second part of the lecture, we will go through Fibonacci analysis, looking at numbers, ratios, retracements, etc. And Elliot wave theory, much of the mathematics of it, which you'll see there's not actually much, but much of the pattern creation is based on these Fibonacci numbers. Chances are some of you have seen Fibonacci numbers before, and if you have, then good. If you haven't, then that's okay. It's not very complicated. So we will go through Fibonacci analysis as well and see how that fits in to Elliot wave theory. So one note of caution before we start: like any technical based theory, this always talks about what is likely to happen. So chances are we won't see things pan out exactly the way Elliot wave theory tells us they will, but it can be used to make predictions, what is most likely to happen. That's how we need to think about wave theory, and of course technical analysis in general. So with that, we will now carry on and start discussing the actual theory itself. Basic tenets. So now we want to create the building blocks of Elliot wave theory. Wave theory consists of three concepts. We have the pattern, the ratio, and the time. So let's talk about what each of these things are. So according to Elliot wave theory, the first concept we need to look at is the pattern. That is, the wave theory tells us that we should see a certain type of pattern in stock charts. Okay, that's the pattern. The second part, the ratio, talks about the length of the patterns. So if we look at the size of different movements, how far up or down does it go? It should move in certain ratios, and these will be Fibonacci ratios that we'll see later on. And the last concept is time. So there should be time frames within which Elliot wave theory moves, within which we see up waves and down waves. Okay, and they actually go in order of importance. So the most important is pattern, followed by ratio, and then time. And we'll see towards the end that time is actually sometimes not even used. It's not considered as important as the other two. So we'll start talking about the pattern first when we talk about the basic tenets. So stock markets follow a repetitive pattern of a 5-wave advance followed by a 3-wave decline. Now just think of a wave as a straight line going either up or down, right? So a straight line maybe diagonally because we're also moving across in time. So an up movement would be a diagonal line upwards, a down movement would be a diagonal line downwards, and these would be waves. So in general, we will see a 5-wave advance followed by a 3-wave decline. Now I'm going to talk about this as if we are in an uptrend. So in an uptrend we'll see a 5-wave advance and a 3-wave decline. In a downtrend we would see a 5-wave decline and a 3-wave advance. So you can just reverse it in your head when we're talking about downtrends. But throughout this lecture we'll talk about it in the context of uptrends. So during an uptrend, during the first 5-wave advance, we have 5 waves which we number 1 through 5. Now waves 1, 3, and 5 are called impulse waves. They move with the trend. So if we're in an uptrend, wave 1 will be upwards, wave 3 will be upwards, and wave 5 will be upwards. And waves 2 and 4, which come in the middle of those two, are going to move against the trend. Okay, so wave 2 and 4 are corrective waves. Now if we have a wave upward, the next wave is always going to be in the opposite direction. Right? So if following an upward wave, we'll always have a downward wave and vice versa. So wave 1 will be an upward move, then we'll have a downward move wave 2, upward move wave 3, downward move wave 4, and then upward move wave 5. So that is the 5-wave advance. And following the 5-wave advance, we will have a 3-wave correction. The 3-wave correction we will label as wave A, wave B, and wave C. And in this 3-wave correction, we'll see wave A downwards, wave B upwards, and wave C downwards. So 2 out of those 3 will be downward moving, and that will be an overall correction. So now we will go ahead and look at what this actually looks like in terms of a pattern, and we'll see how we can use this analysis. Basic pattern. What we have here is the basic pattern of wave theory that we just talked about in the last slide. So now you can see my red pointer on the screen. The labels I've put are the waves. So 1 refers to wave 1, 2 refers to wave 2, etc. And we also have wave A, B, and C at the end. So let's go through this. So we have a 5-wave advance, and we have a 3-wave decline, which comes at the end. So the 5-wave advance works as follows. This line here is wave number 1. Okay, that's an upward moving wave. This wave here is wave 2. This wave here is wave 3. This wave here is wave 4. And this wave here is wave 5. Now what is important to know is that the entire line, so like from here for example all the way down to here, that represents the wave. So the whole movement is that wave 1. Now what we can see from here is that wave 1, wave 3, and wave 5 are impulse waves. They move in the direction of the trend. So here we have an uptrend, alright, because we've got the 5-wave advance that goes up and the 3-wave advance that decline that goes down. So waves 1, 3, and 5 are going up. Waves 2 and 4 are these smaller corrective waves. Okay? So from wave 1 through 5, we now have our 5-wave advance. So we're starting at this point down here, and we're ending up at this point up here. This is the 5-wave advance, the first part of the waves. After that, we have the 3-wave decline. And that's going to be wave A over here, wave B over here, and wave C over here. In this case, we can see that the overall outcome of the 3-wave decline is a decline from this point here to this point. We have a decline first, then a small upward correction, and then another decline. And this is the 3-wave decline. So according to Elliot wave theory, stock prices move in this pattern. We'll see a 5-wave advance followed by a 3-wave decline. And this we should see repetitively. Wave subdivisions. The next concept we want to talk about are what is known as wave subdivisions. Now, the wave cycle we're talking about, that is the 8-wave cycle, will exist no matter what time frame we are looking at. So according to Elliot wave theory, we recognize that there are different degrees of trend, from very long term to very short term. So we can have trends that last a few hours, a few days, weeks, months, and even years. So we can have any different length of trend. And we should see this 8-wave cycle no matter what time frame of trend we are studying. So whether we are studying a yearly trend or a daily trend, we should still see the same 8-wave behavior. So how does this manifest itself in the pattern itself? Well, what we will see is that each wave subdivides into waves of one lesser degree. Okay, so we can break down a particular wave movement into further waves. And we'll see what this looks like in the next slide when we actually look at the pattern. But you can just think of it this way. So if we have wave 1, for example, if you remember wave 1 on our last slide, that was an upward wave, right? That was 1 out of the 8 pattern. That upward move can also be divided into additional waves. So if you remember waves 1 and 2, so a move up and then a smaller move down, that was 2 waves. We can subdivide that into an 8-wave pattern. Okay? So the first 2 waves that we saw on the previous graph, waves 1 and 2, we can subdivide that into 8 waves, 5 going up and 3 going down. So we create this 8-wave cycle. So 2 waves can subdivide into 8 waves, which can then subdivide into 34 waves, which can subdivide into 144 waves. And these numbers are actually part of the Fibonacci sequence. There's 34 and 34, 144, and 2, which we'll discuss later on, as we said. So this is kind of showing you, starting out now, the underpinnings of Elliot wave theory, how it kind of ties in with this Fibonacci number sequence. So what's important to note is that it's just like looking at major trends, minor trends, and intermediate trends. So you have a minor trend, and that will be part of some intermediate trend. You'll have various intermediate trends that are part of a major trend. So it's just like that with waves. You have wave cycles. A small wave cycle would be part of another bigger wave cycle, which will then itself be part of an even bigger wave cycle. So we will have these wave subdivisions throughout. Let's now take a look at a pattern and see what this looks like. Subdivision pattern. Okay, so now I've essentially drawn for you what is the same graph as before, but with more waves. And if this looks a little complicated, we'll just go through it step by step. It should be fairly clear. So what we have here, okay, is I have labels for each of the waves, and each of these represents a different wave sequence. So the black labels, so whenever we have a label in the color black, that represents the very short-term wave sequence. Blue slightly represents a slightly longer-term wave sequence, and that's what we saw. This is equivalent to the wave sequence we saw in the first slide. And green, which you can see there's just 2 of them, one here and one down here, represents an even longer wave sequence. So now imagine an uptrend. Let's look at these step by step. So I'm going to start with the green. Okay, so we just have 1 here, alright, and we have 2 here. So in this case, all we have are 2 waves. We've got, starting here, that's wave 1 up to there, and then here, the corrective wave down is wave 2. So I'm not even showing the 8-wave cycle on this, is just 2 waves. Right, so that is the largest trend we have on this pattern. Then we have the next trend, which is the blue ones. So in the blue ones, it's going to be similar to the picture we saw before. We've got a 5-wave advance. 1, that's the first wave. That's down to the second wave. That's the third wave. That's the fourth wave. That is the 5th wave again. Then we will have the ABC correction. A wave down here, B down here, B up there, and C down here. Right? And you can see these correspond to the blue values. So that now is the 8-wave pattern across this whole graph, right? 5 up and 3 down. And now within all of these, we are going to see small 8-wave patterns throughout this. So looking at the near-term trends, we have an 8-wave pattern that starts here, okay, and that ends over here at C, right? So starting at 1, ending at C. So we have 1, 2 down here, 3, 4, 5. That is the upward movement. And then we have the ABC correction, 1, 2, 3. So this from here to here completes an 8-wave cycle of the, I guess, the shorter term trend, right? The most shorter term trend on this graph. And likewise, we have the same thing here. We have 1, 2, 3, 4, 5. That is the 5-wave upward movement, followed by ABC correction. And that is this another 8-wave pattern. And again, 1, 2, 3, 4, 5. All right, and then and then actually we're going to stop here. It's not going to be an ABC correction. Sorry. So we've got 1, 2, 3, 4, 5 to up here, and this is where it actually ends. So now what we will have is we're going to have it go the other way, right? Because it's now going down, what we will see is that we have 1, 2, 3, 4, 5 going down, and the ABC correction will be going up because the trend has now changed. The short-term trend has changed, right? So our long-term trend in this case is still up, but our short-term trend has changed. So in this case, we've got 5 going down and then 3 going up, ABC correction, and then another 5 going down, 1, 2, 3, 4, 5. And then if we draw it again, there'd be 3 going up, and so on and so forth. So now you can see from this pattern that we can subdivide waves into smaller waves, and each wave pattern comprises another larger wave pattern, and this can keep going on repetitively. So we have 3 different wave cycles we're showing on this one picture, and we can show even more if we wanted to. Corrective waves. So now we have talked about the general pattern of waves. We've looked at the 5-wave upward pattern followed by the 3-wave downward pattern, and we've looked at how that looks on its own, and then we've also looked at how it looks when we subdivide it into smaller waves. The next thing we're going to talk about are what are known as corrective waves. So if we're looking at the 8-wave sequence, the 1 through 5 sequence is the impulse waves, right? The major trend, in the one that goes in the direction of the trend, and the ABC are the corrective waves. So I want to spend a little bit of time talking about those corrective waves and how we can recognize them, and how they are different from the 5-wave advance. So the first thing to know is that the impulse waves, that is the ones in the direction of the major trend, come in 5s, as we've seen, and corrective waves almost always come in 3s. So we're most likely to see an ABC pattern for corrective waves, and they pretty much never come in 5s. Now again, everything we're talking about is what the theory is telling us. So if I say to you, waves come in 3s or waves come in 5s, you need to take that as, this is what the theory says, this is what we are likely to see. This is not what will happen all the time, right? So sometimes you will see a corrective wave in 5. I'm sure if you look for it, you will find it. The point is that we're looking at what happens the majority of the time. So just keep that in mind throughout the rest of this lecture, because what we're going to be doing is talking about different attributes of that wave pattern, different things that we are going to observe, and just take them as this is what we are likely to observe. So what are other things we can say about corrective waves? In general, they are more difficult to identify and more difficult to predict. This is as compared with the normal impulse waves. So the 3-wave pattern is harder to see and spot as compared with the 5-wave pattern. We are going to go through 3 different types of corrective waves. They're called zigzags, flats, and triangles. We'll look at how they work, and these are 3 different patterns we can expect to see when we find corrective waves. Zigzags. This is the first of the 3 corrective wave patterns we will look at. They're called zigzags. So this is a wave pattern that goes against the major trend, right? Again, all the corrective waves are going to be ones that are going against the major trend. It can be a bullish or bearish pattern. So in the diagrams that you see below the writing, I've shown you what it looks like when the price is going down overall, when the overall trend is down. So that will be following a 5-wave advance. This is a 3-wave decline. And this can go the other way too. So if we had a 5-wave decline, we could see a 3-wave advance. So it could be a bullish or a bearish pattern, depending on what occurred first. So we will just show it in this state where it is going down, and you can imagine it'll be the same when it's going up. The main characteristic of the zigzag is that we break down into a 5-3-5 corrective sequence. So the zigzag has 3 waves, A, B, and C, and each of those waves has its own number of waves. So the A wave has 5 waves in it, B has 3 waves in it, and C has 5 waves in it. So that is the 5-3-5 sequence. The other thing to note is that the B wave does not reach the beginning of the A wave. So if you look at the picture, we see the A wave from the top of the A wave to the bottom of the A wave. The top of the B wave does not reach where the A wave started. And the C wave goes beyond the end of the A wave. So if you can see the C wave, now just look at the picture on the left here. The C wave falls below the end of the A wave. Okay, so I'm just going to use my pointer here. So we have the A wave which is this one, and you can see that it goes from here to here. Then we have the B wave, which is this one, that ends here, and this does not reach the beginning of the A wave. So it always ends up lower than this point here. That's what we need to know. And then we have the C wave, which is this one, and this wave ends up lower, that is this point here, ends up lower than the A wave. Okay, and the same thing would be if we reversed it as well. So this is the basic pattern, what it looks like. Now let's turn to the right side, and we will see, we want to look at the corrective 5-wave sequence here. So we have 5 waves, 1, 2, 3, 4, 5, going down to A. So this whole thing, okay, is the A wave, right? This whole thing here is the B wave, and this whole thing here is the C wave. Now this, you can see there are 5. There's 1, 2, 3, 4, 5 in the A wave. There's 1, 2, 3 that make up the B wave, and there's 1, 2, 3, 4, 5 that make up the C wave. So that is the 5-3-5 sequence, and this is a zigzag. Flats. The next corrective pattern we would look at is what is known as a flat, and like the zigzag, it is also a 3-wave corrective pattern. So it's going to consist of the ABC wave, and it is going to go against the major trend, just like the zigzag. The main difference is that it is more of a consolidation pattern. So while the zigzag pattern was either bullish or bearish, so it either had an overall downward or overall upward movement, as we saw. So in the previous picture we saw it as an overall downward movement, but it can also be the other way around. The flat pattern is more of a consolidation, whereby we don't see much overall movement. And this is also an ABC wave pattern, so it comes following a 5-wave pattern before it. Now the main difference between this pattern is that instead of a 5-3-5 sequence, it's going to break down into a 3-3-5 sequence, and I'll go through the diagram as well. And the other thing to note is that the length of the waves are roughly the same, A, B, and C. So we'll have the B wave that reaches the beginning of the A wave, and the C wave that reaches around the same level as the A wave. So let's look at the picture and see what we can understand from it. So I'll start on this side. So this is what the flat looks like. So now we are on the left side. This is what the flat pattern looks like. We have our A wave here, we have our B wave here, and we have our C wave here. So here we have waves of roughly the same length. We have the A wave that goes from here to here. Now we have the B wave that reaches the level that is the beginning of the A wave. So this level here should be around equal to this level here. Right? If you remember the zigzag, the B wave only went up to, didn't go all the way up. Following that, we have the C wave, which goes from here to down here, and this should reach around the same level as the A wave here. So this should be at the same level as here. So that is what the flat pattern looks like. Now let's look at the 3-3-5 sequence. So we will have from here to here is wave A. From here to here is wave B. And from here to here is wave C. And these are the points where the waves start and end. So just draw those in there. So now we have a 3-3-5 sequence. So A wave has 3, which is 1, 2, 3. The B wave also has 3 waves, 1, 2, and 3. And the C has 5 waves, 1, 2, 3, 4, 5. And this is what the flat pattern looks like. So we have the 3-3-5 sequence, and we have the waves reaching approximately the same length, and this resulting consolidation pattern. Triangles. Now, the next concept we will talk about are triangles. Now, we've seen triangles in a previous lecture when we talked about continuation patterns. This is going to be slightly different, but also similar. This is going to be triangles in the context of Elliot wave theory. So triangles are patterns that appear that usually occur in the 4th wave of a 5-wave sequence. So if we have a 5-wave sequence, waves 1, 3, and 5 are the impulse waves, waves 2 and 4 are the corrective waves, and wave 4 often comes up as a triangle. So the final corrective wave often appears as a triangle, and that is the final wave means it's the final move before direction back in the major trend. We can also see triangles in the B wave of an ABC sequence. So if we have an A going down, then a B going slightly up, a C continuing to going down, that B can also be a triangle pattern. So in general, the triangle pattern will always be the move before the final wave in the direction of the trend. So let's think about what do triangles mean in the context of an uptrend. Well, triangles give you 2 indications. They can be both bullish and bearish. So why is that? Well, now imagine that we have a triangle in a 5-wave pattern, and the triangle is the 4th wave, which is a corrective wave. So if we're an uptrend, that wave will be a downward move, right? Makes sense. So a triangle will be bullish because it indicates a resumption of the prior trend, right? It indicates that the wave 5 will come next, which will continue in the direction of the prior trend, which in our example will be upwards. So in that sense, it is bullish. It can also be bearish because it indicates the final part of the uptrend. So we know what happens after the 5th wave, right? After the 5th wave, we see an ABC correction. So it is also a bearish signal because it signals the end of the uptrend. Now, we haven't drawn any triangle diagrams. I've not done that because we've already seen them before. So we can classify triangles into ascending triangles, descending triangles, symmetrical triangles, and expanding triangles. So in that sense, the triangles will look the same as the triangles we discussed earlier. So in the lecture on continuation patterns, we went through all the triangle patterns. So if you need to refresh your memory on what they look like, I would suggest going back to that. And that's it essentially. We're just going to have these triangles. They're going to look just like the triangles we've learned about. And what we can take away from the triangles is similar to what we took away from the triangle patterns in that lecture. The main difference here is that we are going to look at it in the context of waves. So we look at it as a corrective wave that occurs before the final move in the direction of a trend. Rule of alternation. The rule of alternation is a separate concept in Elliot wave theory. So now we've gone past looking at corrective waves. We're going to look at a couple of other details about Elliot wave theory before we move on to Fibonacci analysis. So one of these things is called the rule of alternation. According to the rule of alternation, the market usually doesn't act the same way 2 times in a row. What this means is that if we see a particular pattern occurring, we are unlikely to see that same pattern the very next time the market moves. So for example, let's say we see a head and shoulders top. So we see a standard head and shoulders pattern, and the next time the market makes a top, we are unlikely to see the same pattern. So that is the rule of alternation, is that we're not likely to see the same pattern 2 times in a row. If we see a head and shoulders pattern once, we might see a different type of top pattern the next time. And really this is telling us more about what not to expect rather than what to expect. So if we've seen one particular pattern, this tells us that next time we should not expect the same pattern to occur. And the other thing about the rule of alternation, so there's also the word alternation. Alternation means taking turns, one after another, but then coming back to the initial one after skipping it once. It's alternating. So we will often see corrective patterns alternate. So if you remember, we talked about the different corrective patterns. So we might have a zigzag could be one of the corrective patterns, and then we could have a triangle in the second corrective pattern, or we could have a flat. So there are these different types of corrective patterns, but we are very unlikely to see two zigzag corrective patterns in a row. We normally like to see a zigzag, then maybe a triangle, and then maybe back to a zigzag. So that is the rule of alternation. And often what we also see is that simple patterns will alternate with more complex patterns. So this could be anything. We could see, for example, a simple double top followed by a more complex triple top, right? It really could be anything. You just have to use your imagination here. And this is just an empirical observation, so saying that corrective patterns often alternate between one another, and also saying that simple patterns often alternate with complex patterns. And this is the rule of alternation. Price channels. Now we will talk about a concept known as channels, and we have seen channels before. Let me just refresh your memory. So when we were talking about drawing trend lines, that is connecting the lows or highs on a graph to make a trend line, we can also draw a parallel line which creates a channel. The parallel line will be on the other side of the price, such that the price movement occurs within the channel. So that was a channel. And price channels are quite central to Elliott wave theory. According to the theory, waves often take place within channels. So we can draw this channel and we should see all our movement, all the waves taking place within this channel. So again, a channel consists of two lines which encompass the price movement. How do we draw a channel? Well, when we have an uptrend, we draw first the trend line, which will be below the price, and then we draw a parallel line which is above the price, and that becomes a channel what the prices move within. So the prices move within the channel, and by wave theory the waves are moving within that channel as well. So what will happen if the wave sequence breaks that channel? Well, if a particular wave sequence breaks a channel, then we would need to redraw the channel lines. So it doesn't necessarily mean that the channel is wrong, it just necessarily means that the channel has changed. So if there's a sharp upward move, let's say we have an uptrend, we may have to change the slope of the channel so that it goes up even, it's steeper, indicating a faster uptrend. So we can redraw the channel as we see if we have an instance where the price or the wave breaks the channel. Now, one of the other important features about channels is that during an uptrend, so during an uptrend and during the 5-wave sequence, the waves 1 through 5, wave 5 should come close to the upper channel line. So on the channel, during an uptrend where price is moving within that channel, on the 5th wave we should be coming towards that channel line, right? So that's kind of tells you where your channel should be in relation to where the price is. Fibonacci numbers. So now we have concluded some of the preliminary discussions on Elliott wave theory. We will now turn to talk about Fibonacci analysis and look at how that fits into wave theory. The first thing I want to talk about is the Fibonacci number sequence itself. So what is the Fibonacci number sequence? Well, it was invented by a famous mathematician who went by the name Fibonacci, and he invented this number sequence, or discovered it, and this number sequence has some particularly interesting properties. So let's start by showing you the number sequence itself. So now if you look at the first line, we have 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, and so on. So how do we come up with this number sequence? Well, the sum of two consecutive numbers will equal the next higher number. So each number is the sum of the previous two numbers. So if we start with 1, 1, you can see that 1 plus 1 is 2, so the next number is 2. Then 1 plus 2 is 3, so the after 2 comes 3. Then to get the following number, we do 2 plus 3, which is 5. We do 3 plus 5, which gives us 8. We do 8 plus 13, which gives us 21. 21 plus 13 gives us 34. 34 plus 21 gives us 55. 55 plus 34 gives us 89. 89 plus 55 gives us 144. 144 plus 89 gives us 233. And this is how the sequence continues. So what is special about this sequence? Well, what is special is what is known as the Fibonacci ratio. So the ratio of one number to its next highest number approaches 0.618. So if we take the ratio, for example, take any two numbers in the sequence, the ratio of the lower number to the higher one will be 0.618. Now, at the start of the sequence, it won't be exactly that, but as we go through the sequence, it will approach that number, and within a few numbers, it will pretty much be at 0.618 throughout. Okay, so that's the Fibonacci ratio, which is quite important. And just like that, the ratio of one number to its next lowest number will approach 1.618. So if we take the same two numbers and do the ratio the other way, right? So if, let's say we took 55 and 89. If we did the ratio of 55 to 89, this would be 0.618. If we did 89 to 55, this would be 1.618. So that is also the Fibonacci ratio. And the ratio of two alternative numbers will be 2.618. So if, for example, we took 55 and 144, the ratio would be either 2.618 or 0.382, depending on if we put the smaller or higher number first, just like with the single number ratios. And this essentially gives us the Fibonacci ratio, which is very important to wave theory, and Fibonacci retracements as well, which we'll see later in this lecture. So now this ratio only comes about slightly later on in the sequence. So the sequence extends infinitely. And the first few numbers don't have ratios that are close to 0.618. They do approach it though fairly quickly. And by the fourth, fifth number, you'll see that it's practically 0.618, and that stays constant throughout the number sequence. Fibonacci ratios. Now what we are going to do is go through some of the ways in which we can apply Fibonacci ratios to Elliott wave theory. So within the Elliott wave theory, if you remember, we said that we had pattern, ratios, and time were the three things that we needed to be aware of. So we've looked at patterns so far in this lecture by looking at the wave patterns and the corrective wave patterns. Now we will look at the second part, which is ratios. So ratios is looking at the length of each waves in relation to the other waves. So we're going to go through some of the common relationships that are observed, and this is what Elliott wave theory tells us we should see. Now, if you find it slightly complicated to follow, don't worry, I also found it the same. The thing to know is that you just have to read it quite carefully, if you really want to picture what it looks like. So I'll just go through them, but feel free to stop yourself and read through it in detail if you need to understand it better. So here's the first relationship. One of the three impulse waves often extends, and the other two are equal in time and magnitude. So the impulse waves are the waves 1, 3, and 5, right, within our 8-wave corrective trend. And what we are most likely to see is that one of those three waves will be long, will be extended, and the other two will be roughly equal. So we're likely to see two equal length waves and one longer wave. So for example, if wave 3 is the extended wave, then waves 1 and 5 will be around the same length. The second thing we will look at, a minimum target for the top of wave 3 is obtained by multiplying 1.618 by the length of wave 1 and adding it to the bottom of wave 2. This 1.618 is the Fibonacci ratio. So what does this mean? Well, a minimum target for the top of wave 3. So we're looking at how high does wave 3 go? What is the minimum length that wave 3 should be? So this is within our 5-wave sequence. And we're looking at it in the context of uptrend, 5-upward trend, 5-wave uptrend. So to get the target for the top of wave 3, we take the length of wave 1, multiply it by 1.618, and add it to the bottom of wave 2. So we take wave 1, it'll increase in size because we're multiplying it by 1.618. We move that to where the bottom of wave 2 starts, and that length should tell you the target minimum top of wave 3. Alright, so now here we've seen two different examples where we've applied Fibonacci ratios in order to determine magnitude of waves. Now we'll look at some of the other ones. There are 8 of them we're going to look at in total. So let's carry on. Fibonacci ratios. 3. The top of wave 5 can be found by multiplying the length of wave 1 by 2 times 1.618 and adding that to the top or bottom of wave 1 for the maximum and minimum targets respectively. Let's explain what this means. Again, we have our 5-wave uptrend pattern. The top of wave 5 is looking at the highest point for wave 5. How do we find this? Well, we take the length of wave 1, multiply that by 2, so we double it, and then we again multiply it by the Fibonacci ratio, 1.618. So now we're going to have a wave 1 that's times 2 times 1.618. We add that length to the top or bottom of wave 1, and this gives us the maximum and the minimum target. So if we add it to the top of wave 1, that gives us the maximum target. We add it to the bottom of wave 1, that gives us the minimum target. Alright, so the top of wave 5 will be somewhere in between that maximum and minimum. And this is how we are going to find wave 5. So you can think of how to use this. If we have the first wave, if we've seen the first wave in the 5-wave sequence, we want to know where we expect the 5th wave to be. If we want to trade based on that, we can use this analysis to find a target. 4. If waves 1 and 3 are equal in length, wave 5 will extend. This is partly back to what we said in one of the earlier ones. To find the final price, we take the distance from the bottom of wave 1 to the top of wave 3 and multiply by 1.618 and add the result to the bottom of wave 4. Again, it's quite a few different instructions here, but if we just go through it one by one, it's not very difficult. So if we have waves 1 and 3 are equal in length, wave 5 will extend. If you remember, we said that if 2 waves are equal, 2 of the impulse waves are equal, one of them will be extended. So once we see waves 1 and 3 being equal, we'll know that wave 5 is going to extend. To find the final price, we can take the bottom of wave 1 to the top of wave 3, that distance, right? We multiply that distance by 1.618, the Fibonacci ratio, and then we add that result to the bottom of wave 4, right? So we're going to have a length between 1 and 3, top bottom of 1 to the top of 3, and multiply it by this ratio, add that to the bottom of wave 4, and that gives us where we expect wave 5 to finish. Number 5. This is an easier one. In a 5-3-5 zigzag correction pattern, wave A is equal to the length of wave C. So when we see a 5-3-5 zigzag correction pattern, if we've seen waves A and B, we can expect wave C to be equal to the length of wave A. Fibonacci ratios. 6. So another method we can use to find the length of wave C is to multiply the length of wave A by 0.618 and subtract that from the bottom of wave A. Okay, so let's think about how we would do this. So if we have an ABC correction, one way which we can find the length of wave C, we would take the length of wave A, multiply it by 0.618, which is a Fibonacci ratio, so that will make it smaller, and then we subtract that length from the bottom of wave A. Alright, and this will give us how far low, where will wave C reach. Alright, so that is how to find the length of wave C. Number 7. If we have a flat 3-3-5 correction pattern, wave C will equal 1.618 times the length of wave A. So, in a 3-3-5 correction pattern, that is, we have our flat corrective pattern, which is an ABC pattern, we will have wave C equal 1.618 times the length of wave A. Alright, and this is just another rule which is easy to apply. And we know that wave C will be bigger because it's 5 instead of 3, so it's 3, 3, and 5, which means the A and B are 3 and C is 5, so we expect C to be bigger, and it should be bigger by this ratio 1.618. Number 8, in a symmetrical triangle, each wave is related to the prior wave by a factor of 0.618. So now in a symmetrical triangle, if you remember, what happens in one of these is that we see up and down movements, in this case up and down waves, that get smaller as the triangle, as the sides of the triangle converge. And each wave will be essentially equal to the previous wave times 0.618. So it'll be smaller by a factor of 0.618. So that's how we can calculate the length of that wave. So what we have seen here in these 8 different rules is that we use Fibonacci ratios to find the magnitude of the waves, right? How long will the waves be? How wide will they be? When will they extend? When will they not extend? We can use Fibonacci ratios to do this. And this is quite an integral part of Elliott wave theory. Because what we're going to do if we want to trade on this information is that we are going to see part of the wave pattern, not all of it obviously. We need to trade before the entire wave pattern comes. We'll see part of it, and then we will use this to get an estimate of where the wave is likely to end up going. So once again, just to reiterate, these are obviously all estimates. These are just what we are likely to see. We never see exactly these things, but these are estimates, and these are what we need to go by if we are applying Elliott wave theory and Fibonacci ratios to our analysis. Fibonacci retracements. Now here is something that chances are many of you have seen before. Fibonacci retracements are a method which we can use to determine the length of a price correction. Now, this is slightly separate to Elliott wave theory. We don't really talk about waves too much. We do use it in the context of waves, but it can be applied even if we're not using waves, if we're just using general trend analysis, for example. So, if you remember, when we talked about trend, we talked about how following a trend, the price will usually retrace a portion of that move. And in Fibonacci retracements, what we are expected to see is that the price will retrace a certain portion of that move that is related to the Fibonacci ratios. So the Fibonacci ratios will be 0.618 and 0.382, that are the important ones. And we also have 0.5 as a retracement level. So these will be our main retracement levels. There will be 0.618 or 62%, there will be 0.5 or 50%, or 0.382 or 38%. So if we just look at the top and bottom numbers, that is 62% and 38%, during a trend, we should expect to see the price retrace between 38 and 62% of the move. Right? So in between these Fibonacci ratio numbers, we should see the trend retrace part of within that. So if we have a strong trend, then the price will retrace closer to the minimum level of 38%. If we have a weak trend, the price will retrace closer to the maximum retracement level of 62%. So one thing that is important to know here is that when we see that this does not occur, so if we see a retracement greater than 62%, greater than this Fibonacci retracement level, then it's possible that we have a change in trend.